Welcome to Trading Nation, folks. I'm Eric Chemi. Today we're joined by Doug Gordon. He's Senior Portfolio Manager at Russell Investments. Doug, thanks for joining me here on Trading Nation. I want to get right into it with you. These markets starting to get real volatile. If I've got new cash to use here, am I waiting to buy the dip, or do I need to get in right now?
Yeah, it's a great question, Eric. I think right now it's one where we think that there is going to be an opportunity to buy a dip, but it's going to behoove investors to be risk scaled in that. And what I mean by that is to practice incrementalism and to stage deployment, keep some dry powder, see how far we go. Obviously, this is driven by the move that we've seen in rates and the inferred action that would inform for the FOMC, right? If we continue to see inflation pressure and jobs numbers like these for 1-2 more prints, well, that's going to put a lot of pressure on equity and risk assets.
A few months ago in October, you said we're going to see another leg up because of tax reform. That happened, both tax reform and the leg up, so you're right on that. What does your crystal ball tell you now that we've gotten through that positive for the market? What's ahead of us here?
Yeah, we certainly don't have a crystal ball. All we can do is do a very good job of managing risk for our clients. But that said, I think you've got a unique situation here. You've got late stage in the expansion where you've got tightening monetary policy, but then you've got stimulative fiscal policy concurrent with that. That's not only rare, that's almost unheard of. I think that kind of 1 foot on the gas, 1 foot on the brake concurrently is going to make for a unique market. It's one where I think it behooves investors to stay diversified and certainly leverage all the tools they've got in their deck to include asset allocation, currency, option strategies where appropriate, and to be nimble when they can be. I think, again, it's one where you have to have a measured amount of risk to incrementally potentially buy this dip, but high yields right now are certainly going to put some margin pressure on what are very attractive earnings thus far reported this quarter, but it's going to put some pressure on the forward expectation around companies' earnings.
What about interest rates? Because I'm looking at a 10-year that's at 285. A few months ago, we're talking 220. That's a big difference if somebody's trying to get a mortgage, let's say. And does that offset all the benefit of reduction in taxes, these $1,000 bonuses, increased wage growth, increased job growth, if all of a sudden it's just much more expensive to get things done?
No, it's an insightful question, Eric. I think it's going to be kind of a yin and yang, if you will, right? You're going to have on one side, people are going to be getting these one-off bonuses, but if they do get increases to their wage or increases to comp that's ongoing, well, that's going to have a more material impact in terms of their ability, discretionary income, or their discretionary spend that they're going to be able to have. The higher cost of lending, yeah, that certainly can impact that first-time home buyer or somebody who's looking to sell and repurchase. But a lot of people, given the period of time that we had with low interest rates, I think a lot of that volume has already been taken out of the market, and that interest has already been taken out of the market.
Final question. It looks like 2018 is shaping up to be a much more volatile year than last year. What are you telling your clients? Maybe it's buying some out-of-the-money options for protection. What do you do with this volatility here?
That's exactly right. There's some asymmetry to, and certainly when we're at the highs that we saw earlier in the month, there's some asymmetry to the opportunity set. You know, yes, we could continue to go up on strong momentum and kind of the irrational exuberance, if you will, but the downside certainly was there, and we're seeing maybe the first inklings of that right now. So what it behooves our clients and what it behooves investors to do is to make sure that they're looking at the full range of tools that they've got to be diversified in a multi-asset solution that holistically looks at their risk management. And then you're looking at, as you said, option strategies to give away potentially some of that upside to protect on the downside. Tactical asset allocation to take advantage of volatility in markets, active currency strategies, and then, of course, on top of that, I think that this is probably an environment, if we do continue to sell off, where active management is going to be benefited when we get closer to the lows that we eventually will reach with respect to relative to passive exposures.
All right, Doug, thanks for joining me here on Trading Nation. That was Doug Gordon, Senior Portfolio Manager at Russell Investments. I'm Eric Chemi. Thanks for watching. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.